Okay, we're gonna, albeit a few minutes late, we're gonna start the second breakout session on the topic of objective evaluation of private equity options for urology groups. So in order to have an objective evaluation, you're probably wondering, who are these guys up here talking about this, and are they objective?
Hold on one second.
Okay, maybe this is better. So I'm just going to introduce ourselves so you understand who's going to be talking about this so-called objective valuation, and we do believe it's objective. So my name is Gary Herschman. I'm a partner at Epstein, Becker & Green, which is a national law firm, and I've been practicing law for close to 30 years, all in the healthcare field, representing doctors, groups, and other healthcare providers and transactions. And we have offices across the country. We have 130 healthcare lawyers in 16 offices around the country. And sitting to my right is Hector Torres, who's a principal of ECG Management Consultants, and he's a financial advisor. And what's interesting is it's very important for you to understand, if you haven't read a lot about this, he does the same thing that an investment banker does, okay, in terms of helping you look at your financial goals and objectives and potentially exploring possible options for partnerships or investments. But it's very important that when you hear the word investment banker, they're not buying you, they're not investing in you, they're advising you on your options. And in terms of objectivity, both of us, and we're with separate firms. I'm an attorney, he's a financial advisor. Our experience has been that at least half or more of the groups that bring us in to talk about their shareholders and special committees sometimes, or their whole shareholder complement about this, more than half of the times the groups decide to do nothing, meaning not to explore one of these partnerships, maybe to do their own growth strategy or just stay the same. So with that introduction, I'm going to turn it over to Hector.
Yeah, good morning, everyone. As you've probably gathered from reading the papers or just by virtue of being alive, the physician group sector as a whole, from an M&A activity perspective, is incredibly robust today. Both from a volume perspective, meaning the number of deals that we're seeing in the market, as well as the valuations or the terms and conditions of the deals. We're really in a sort of a boom period, as you can see historically. We're projecting actually for the end of this year almost 200 announced transactions in the physician group space. From a valuation perspective, just to contextualize it historically, on average, these deals trade on a multiple of earnings or cash flow or EBITDA, said differently. And historically, those multiples have been between 6 and 8 times on average. There's always nuances related to these deals. But today, as you can see, we're already on a median basis in the double-digit 10.5 times EBITDA range, which is very frothy. Now, private equity is really an industry unto itself, and there's every single type of private equity firm. There are firms that solely invest in minority interest deals. There are firms that exclusively focus on majority interest deals. But we really work to analyze and understand these organizations for inclusion in a potential process based on their investment criteria. They will focus on a specific industry, a sector within that industry. They'll focus on the size of investments. They'll look at things like geography and regional aspects of their investments, and then their variability in terms of the structures that they pursue from an investment thesis perspective. What is the process? What is the ultimate end goal objective for private equity? Well, they're not in the business of holding ownership into perpetuity. They really operate under a 3 to 5 year investment time period and horizon. And what they'll do is they'll typically acquire what's called a platform investment, a much larger practice, and utilize that as the growth catalyst to bring on more smaller practices into it, called bolt-on acquisitions, and ultimately exit the investment in that 3 to 5 year time period. The natural question is, what happens after that 3 to 5 year time period? Well, that's what's called the second bite at the apple. Typically, you as a physician shareholder will have some interest, equity interest, in the new organization that the private equity firm has bought, and you will realize a second liquidity event in the exit 3 to 5 years down the road. Now, urology is very early from a specialty perspective in terms of the investment thesis and horizon for private equity. It really began in the late 90s, early 2000s with dentistry. We saw pain management, and really beginning in 2015 and even today, dermatology has exploded. And the good news there is that a lot of these private equity firms have seen success stories. They've gone way beyond the proof of concept that investments in physician groups and subspecialty physician groups can be very, very successful and return adequate financial gains. We're seeing a lot of interest in really 3 core sectors, and we think they're going to be explosive in 2019. Those are orthopedics, those are women's health vis-a-vis OBGYN, and we see urology already beginning to really, really heat up from a sector perspective. I won't belabor the macroeconomic trends, but obviously urology and the demand for urology services is exploding. It's really bolstered by the baby boomer population, but there are really 3 core fundamental investment theses. There's a supply and demand imbalance. There just aren't enough urologists coming online and coming out of training to serve the needs of the patients on a national basis. Secondarily, it's a very fragmented market. No one organization nationally controls more than 3% market share for the delivery of urology services in the United States. So that is ripe for consolidation, and it's ripe for a growth via acquisition model, which is essentially what private equity does. And then really, there's a lot of synergistic benefits, and there's a lot of what they call operational low-hanging fruit. A lot of these organizations aren't optimized from everything from business practices to back office operations to branding and marketing their practice. So that's where they can create a lot of value very quickly and ultimately enhance the value of their acquisition as a partner. There have been some very large urology-specific platforms that have been formed. These are just some examples of the firms that have formed them: J.W. Childs, Altaris, and Audax Group. And then here you can see some of the additional bolt-on acquisitions that they've recently announced to help grow their.
And they're just from talking to people in the market. There's rumors that there's 2 other platforms that may actually be closed in the next 30 to 60 days. So if you're exploring your options and you're into 2019, there's now going to be, or rumored to be, now 2 additional options. So it seems like it's really kind of erupting, especially when these deals close. And now you're going to have several different private equity firms looking to continue to grow and add on other urology groups.
So we'll jump right into the transactional considerations. What Gary and I really love to do when we work together with clients is we'll spend a lot of time understanding each individual practice's goals and objectives. And those goals and objectives, we'll expand on it, but it really, it runs the entire spectrum of the organization's clinical, financial, and strategic operations. But the good news today is that the market for urology practices is very efficient, and the optionality with regards to who is interested in partnering with you is really at an all-time high. I mean, we're talking about private equity, and there are obviously some pros and cons that we'll expand upon, but they aren't the only buyer out there. There's always the hospital and the health system. They have pros and cons as well, but we're seeing a lot of activity from strategic acquirers like Optum, which is a division of United Healthcare, Humana, all the major strategic payers, as well as some of the natural strategic organizations like Team Health, Mednax, Envision, et cetera. I don't know if you wanted to expand.
Yeah, I think
a little
Mednax recently invested in a urology group in Florida, I believe, earlier this year. So you're going to, as the activity starts to rise, you're going to see a lot more not only PE options, but national strategic companies, big big public companies that are going to have interest. You know, from my experience, the first option of hospitals may be a good option. My experience is that most doctors believe that hospital and hospital executives don't really know how to manage physician practice as well. And so with a lot of the groups I work with, you know, although that's on the table, a lot of groups just take it off the table right away. Other groups want to keep it on the table, have a good relationship, but there are some limitations to what hospitals can pay, you know, in light of the Stark and kickback laws. But there's more than just these three options. Another option is to continue growing your practice itself, maybe merging with another practice of equal size, or even being acquired by a large multi-specialty practice that might be in your geography.
So really, this is the core of planning and articulating a best-in-class process, is really solidifying your organization's goals and objectives. Every organization is different. Every market's different. You all know that healthcare is very, very local. We're working with a group in Columbus, Ohio, and everything from the regulatory and payer environment in Columbus is very different than an independent physician group that we're working with in Napa Valley, right? So really solidifying these goals and objectives. What are the capital and resources for growth that you need in order to grow the value of your practice? What's the cultural alignment and what are the parameters of the ideal partner? Private equity firms run the spectrum of, really wanting to be aggressively involved in driving the strategy and the operations of the practice, to being a minority investor that says, listen, you guys are an amazing asset and we just want to sit back and go along for the ride and you guys run the show. We're just going to take a minority interest, and obviously everything in between. So cultural alignment is critical, and it's actually a lot of the non-financial terms and conditions that make for an ideal partnership with private equity, such as cultural alignment, governance rights, and operating model. If someone is going to pay a lot of money and get a majority equity ownership interest in your practice, they're likely going to want to have influence over the operations and likely have a majority say in terms of governance and your board if you have one. And then lastly, monetary and economics. Really important, but modulating around, is upfront liquidity important, or are you interested in rolling over equity into the new combined organization and getting a liquidity event in that 3 to 5 year period down the road, or some combination of the two? Aligning around all of these, we spend a lot of time with our clients really understanding and really solidifying these. And goals and objectives are not written in stone. We like to say they're like the U.S. Constitution. They have to be, really solidified, but they don't have to be inflexible. They can modulate and change. And what typically modulates is the prioritization of the 4 attributes and then the sub-attributes below.
So I'm going to chime in on these because, again, this is probably the most important, or one of the most important slides. Capital and resources for growth. Even if your group is doing well now, okay, the real issue that's in a lot of our clients' minds is how are things going to look 3 to 5 years from now? That's the uncertainty. We're probably going to continue this slow transformation of value-based care. And what's going to happen with Medicare? What's going to happen with our big private payer agreements? Are we ready for this transformation that's underway? And so capital for resources and growth, I think, is very important. Data analytics is becoming more and more important, and that's not cheap. Advanced EMR systems, and usually bigger organizations with more doctors and more breadth, usually can invest in these types of things. So bigger is usually better, or using an investor's money for that capital, resources, and growth. Cultural alignment, I want everyone to understand that, if you decide to dip your toe in the water and just, see what options are out there, what type of offers may be out there from all these players in the market, the highest bidder is not always the bidder you want to go with. The cultural fit is very, very important. And you're going to be sitting across the table from these business executives, from a private equity firm or from a national company, Optum or whoever, and you want to make sure that there's cultural alignment and that they're not these sharp elbow Wall Street guys that are just looking to make a buck. So you have to do reverse diligence, meaning the group doing diligence on these offers and these companies that are behind the offers, speak to doctors in other specialties that they may have acquired several years ago or last year, dermatology and ophthalmology in particular. A lot of these private equity groups that are interested in urology have already invested in dermatology, eye care, women's health, or one of these other platforms, and have experience. So you want to look at that and make sure that they actually have a good track record, and how have they built those practices that they invested in over the last several years. And then go out there and meet the doctors, or call them, but I think it's always better in person. And how is it dealing with these investor guys, this PE group? Are they really letting you? They say they're going to, let us do everything the same and just help us with capital to grow. Do they really leave you alone? Do they interfere in your clinical, decision making? Very, very important, because PE groups are, there's a wide spectrum of them, and you need to be comfortable with the one that you decide to go with, and it's not always the highest bidder. And on the monetary value and benefits, one of the most difficult things that if groups are exploring this and still just kicking it around internally is the monetary and structural vision has to work for early career doctors, mid-career doctors, and late career doctors. That's the most difficult hurdle that I've seen. And but in almost every case where that's been a hurdle, after additional education, and sometimes I, as a healthcare transactional lawyer, go in, not just financial advisors who could talk about the experiences of other groups and explain the legal protections and benefits for these early and mid-career doctors. So it's not just the doctors that might be retiring in the next 5 years, the doctors that have a longer horizon with this partnership. And in almost all those cases, when the younger doctors, mid-career doctors in their, let's say, 30s and 40s are educated, they almost always jump on board. And in some cases where there's an option of rollover equity, they want more rollover equity because they've done their research and they think this is a good long-term option.
So we talked about the virtues of private equity and sort of the methodology approach, but certainly we like to say that there's no free lunch, right? So there certainly are some drawbacks, and it's really about going into this process or contemplating this process eyes wide open. And again, to Gary's earlier point, private equity firms run the gamut. I mean, you have organizations that are very hands-on, that really want to drive the operational infrastructure and strategic direction of their investments. Others say, you are the asset that we're buying, and we trust your leadership, your vision, and your strategy, and we're here to support you from an economic perspective. But let's sort of expand on some of the things that we've seen in other specialties, and we certainly will be seeing in urology, and we're already seeing it. There's a real cadence and focus around the bottom line and the financial performance of the investment. Obviously, they have a 3 to 5 year time period, and they really want to be able to optimize and enhance performance so as to ensure that the value is created in their investment. Typically in what we call majority equity recapitalization deals, the private equity firm owns the majority of the entity, so the physicians, shareholders, even if they retain some of that equity, they're going to have less input on governance, right? They're not going to be able to have the same board structure if they have a board, or have the input on the operations and strategy as they had when they were independent, because they've sold the majority interest to the private equity firm. This is, Not so much today, but certainly 10, 15 years ago when physician group investments were new to private equity, there can be a lack of specialty-specific clinical experience and expertise. Urology is a fairly new subspecialty for private equity investment, but there have already been very large platforms developed, and these private equity firms typically exclusively focus within healthcare services and or if not physician group deals. So they will have some institutionalized knowledge of, what are the nuances of your practice and et cetera. But again, running that spectrum, there could be a lot of private equity firms that have no track record or experience, and that can be a potential drawback to getting into partnership. The two final ones are really that short investment horizon. They are essentially looking to hold you, grow you, and essentially flip you over to what is typically a larger private equity firm, and we can talk about the second bite at the apple and then the third bite at the apple in a bit. And then lastly, there's typically very little flexibility with regards to how back office operations or how back office synergies are realized. If they have a platform and you're a bolt-on and they're doing all of the marketing, the legal, and the accounting at the platform, those operations at your practice typically go away. Now, if you don't have institutionalized accounting, marketing, legal, et cetera, that's a benefit for you, right? Because they're gonna impute those services and capabilities onto you. So it is sort of a two-way street with regards to that, but back office operations are also a consideration and a potential drawback.
Right, so there was a question about, is it better to be a bolt-on? And the answer is, it depends what your practice's makeup is. Our experience is that a practice that's got a management team in place and almost like a chief financial officer, a CEO, an HR executive, and not just an office manager that kind of does it all. So usually larger groups have more of that back office kind of corporate headquarters infrastructure. And those groups are more likely to be the platform investment, okay? Because what's going to happen is that the private equity firm, and this goes to pros and cons too, the private equity firm is going to look at your practice, a larger practice with all this management infrastructure, and they're going to value you very significantly if it's a large group like that, probably in the tens of millions of dollars, and some that we're talking to now north of 9 figures, so over $100 million. So the way, if you're going to invest 60 million, 110 million in a company, you're not going to go change everything, right? They're going to invest in you and partner with you is what they'll call it, but also provide capital for expansion because they like you, they like your model, okay? And so it's, in my experience, it's very uncommon for a private equity firm to invest all this money and then come in and change things. That's not the case. Most of them don't do that, and you'll flesh that out when you do diligence on them to see what they did with other physician groups, okay? Because they're going to tell you, we're not going to touch anything clinical, and we love your back office, and we want to invest in you, and we want to do add-ons, all using your corporate infrastructure for all of these add-ons for economies of scale and growth. So a bolt-on is usually a smaller practice, and usually the multiples are lower. The multiple of EBITDA, which is the way they value the practices, which we'll get to later, is usually lower. Do you want to comment on that?
Yeah, I mean, it really is nuanced and very specific to each deal is different. We've seen instances where we've advised physician groups and they had all the infrastructure and they wanted to be a platform, but got a very, very high offer as a bolt-on to a very larger platform, right? So really, it's so specific that it's very difficult to delineate, but if we had to delineate it, what we're seeing as a multiple of free cash flow, which is how these deals are done, is that in physician group, specialty physician group deals with private equity, the platforms command a premium of about 8 to 10 times free cash flow or EBITDA, whereas the bolt-on investments are in the range of anywhere from 6 to 8 times free cash flow or EBITDA. But again, that's a very academic, one-dimensional approach. Every deal is different, but in general, that's what we're seeing from a market perspective.
Right, and so again, another very important slide, so I want to stay on this. There are drawbacks. There's pluses and minuses, right? So my approach, and when I talk to groups, the approach is that, and I think it makes sense to at least explore, talk about whether, the pros and cons and what are our goals and objectives, as Hector said. But I just want to, I was asked last month to go up to Boston to speak also twice at the MGMA National Annual Meeting in Boston. And it's interesting that they issued a report, right at the beginning of this conference, this annual meeting, called Winning Strategies from Top Medical Groups. And it's like a 17-page report, but I just want to read one line from it. And it's a quote from the MGMA's board chair, and it says this: "You may be confidently leading a practice with healthy margins and happy physicians, but success is no reason for not keeping up with shifts in the industry and having an open mind for the opportunities that exist." So again, I think that kind of sums it up, but our advice is that if other doctors in your group are going to be reading about these deals and saying, "Hey guys," the CEO and vice president, "Hey, have you guys been looking at this? Does this work for us?" And it would be good to have explored it, set up a committee maybe of 3 or 5 doctors at different stages in their careers, and at least explore it so you could go back to them and say, "Yeah, we've looked at this, and for these reasons, this is not right for us. We would only get X, or it wouldn't work, for this reason or that reason." So again, our approach is we think it's good to at least figure out what your goals are and whether some of these options may be worth at least just understanding what the proposals may be from partners.
Yep. So we talked a lot about some of the shareholder considerations, but really it's a very rich tapestry, and it really formulates and helps inform and solidify the goals and objectives. But what are your business growth objectives? Private equity is investing in growth. They're essentially taking futures out on the value of your organization 3 to 5 years down the road. So really having and being able to articulate a business growth strategy goes a long way to ensuring optimal terms and conditions with private equity. You have to have a track record of financial stability and growth, but you also have to have your financial house in order. A lot of independent groups do not have audited financial statements, and they certainly don't have a quality of earnings. Doing a little bit of work up front, and Gary can expand on how we typically work 4 to 6 months even before a process is contemplated to make sure that the house is in order, but certainly from a financial perspective. If you think about how they're financing the deal, they're going out and raising a lot of debt in order to acquire your organization. Your financials need to be pristine. They need to be in order. They need to reflect the financial performance historically and solidify a upward and positive trajectory into the future.
And when Hector says process, I don't mean to interrupt, but
yeah.
What he means is running a process, reaching out to the usual suspects, national companies, private equity companies that he knows, and there's dozens of them that are really interested in getting into the urology practice space, and just to see what interest there is and to come back to you with, and it's very possible that you decide not to even do a process, but if you do a process, it's again, in some instances, and sometimes a lot of instances with smaller groups, it's not worthwhile, and the group takes that information and those proposals and does, talks it through and decides not to do anything, and maybe pursues a different option, merging with a local group or whatever.
Yeah, and the process element is something that I can't emphasize enough. There's not a cookie cutter approach to how we structure that process. We will belabor the goals and objectives and really understand what it is that you're looking for in a private equity partner, and that's across finance, strategy, and clinical operations, and really every facet of your practice, and will inform and develop a customized target list of potential suitor organizations that are in alignment. And really here you see the entirety of the M&A advisory transaction process. Phase one is really transaction planning, where we're honing in on those goals and objectives, assembling our due diligence on you as your advisors, performing of an valuation analysis, solidifying the universe of potential private equity buyers, drafting marketing materials, and essentially launching the first round of the process. In phase two, we've already received first round offers. We'll do further negotiation, refinement, and ultimately run it in a manner that allows you to inform your shareholders and or your board as to which finalists you want to negotiate a letter of intent. Ultimately, at the end of phase two, you will have negotiated and signed the letter of intent, which is a non-binding document, but the only binding elements are that you are agreeing to be in exclusive negotiations with one private equity firm. And phase three is really the transaction execution. This is where we're drafting legal definitive agreements. We're undertaking they're undertaking due diligence on us. We're undertaking reverse due diligence on them. We'll align around any regulatory filings or considerations associated with the transaction, and ultimately with the objective of closing the transaction.
And again, at any one of these stages, you could pull the plug, the go, no go. At any stage, whether it's the initial planning, going through and maybe looking at offers, and even if you even go into an LOI, from time to time, you don't even finalize a deal because of some things that come out in due diligence, and the other party, the investor, is trying to change some terms, and you say, no way. So you can always back out of it. And that process is usually, on the prior slide, is usually a 12-month process. And I'm going to talk about a little bit shortly that there's at least 6 to 12 month time frame, even before this, where, as Hector said, getting your house in order, so to speak. So I'm going to talk about this now more in the context of key legal regulatory issues. So if you decide to go to the phase two and enter into a letter of intent and only be talking to this one potential partner, at that point, there's due diligence. And by due diligence, I mean comprehensive, inside out, upside down, looking at every aspect of your practice. And I say that because it's important that you understand this in advance as to how you need to get things in order, knowing that when you get to this stage, it could be too late or very detrimental to you. So they're going to be looking at, everything, your billing, your coding, and they're going to look at your financial statements. They're going to recast them and bring in an accounting firm to recast you on an accrual GAAP basis and not on a cash basis. They're going to look at your billing and coding and documentation. Are you being overly aggressive, or some of your doctors being overly aggressive? They're going to look at your agreements, any audits, investigations, litigation. Are there multiple sexual harassment complaints against some of the doctors, like not just one-off things, but multiple, problems or potential liabilities. They're going to look at your managed care contracts. They're going to want you to be in network, and they're going to look at how diversified you are in different payers. Again, they're looking at overall, the final bullet here is they want to make sure, is this a sustainable practice, or are there skeletons in the closet and it's not really going to perform the way we think it's going to perform? They're going to look at arrangements with hospitals. Are there Stark or kickback violations? They're going to look at your, if you have an ASC, is that structured correctly in a compliant way? And they're going to look at whether, in addition to coding and billing, do you have a robust compliance program? Yes, they're going to look at that. It's one of the things that a lot of groups are surprised at, but they want to make sure that you're serious about compliance. And this slide just sums it up, that this is the at least 6-month process prior to going out to the market, getting your house in order. If you do this and make sure that everything's clean and that you fill in some gaps if need be, or change certain billing practices, it'll go a long way to making the process much smoother, correcting things in advance, and not going all the way down the road to that deep dive diligence and then having the potential partner saying, wait a second, we saw these issues. We're going to reduce our offer by X million dollars, or only have your rollover equity be a different class of stock, not the same class of stock that we have. So the key transaction issues, just going to zip through this, and if you have questions, please plug them in, and we'll address them all, and we'll stay afterwards too. The purchase price, and how the transaction is structured is very important. In a lot of cases, there will be rollover equity. Sometimes with these national companies, not PE, the PE companies almost always have rollover equity, but some of the national company acquisitions like Mednax and Team Health, they won't have rollover equity, and they may have an earnout instead. And it's very important to make sure that everything is structured in a tax efficient way, meaning that you get the least taxes to have to pay on the purchase price, like capital gains treatment. Even though the difference between ordinary income and capital gains has now narrowed a bit in light of the Trump tax cuts, there's still a difference. And 5 or 6 or 7% is still real money. So it's very important. And when we get involved, we have one of our tax attorneys spend some time with your accountant and really try to figure out what the basis and different assets is, and other aspects of your practice. How long have some of the shareholders just become shareholders and maybe haven't owned the stock for a year yet and won't have the long-term capital gain treatment? Those are all things that we look at and plan in advance with you. And the terms of the rollover equity I mentioned before, in the best case scenario, you want the same equity that the private equity company has, not a different class of equity, and you want to make sure it's voting equity. Your ongoing employment terms is key. It's very important to see how you're going to be paid going forward, what commitments there are, what termination rights there are. Usually there's a 5-year commitment in most of the deals that we're working on right now, and that's very important. And then there's concepts of indemnification, liability, if things come out after the closing that relate to pre-closing periods, like lawsuits from employees or Medicare seeking to take back money, or private payers are now very active doing audits. You have to indemnify for prior pre-closing liabilities. They will hold back part of the purchase price for usually anywhere from 18 months to 2 years, sometimes 3 years, but usually somewhere in that realm of 18 to 24 months as kind of collateral for this indemnification obligation, so they don't have to come after you personally. There's a certain, like 5 to 10% of the purchase price that may be held in escrow to account for that. And then, of course, there's non-competes. So as with any other transaction where people are investing tens of millions of dollars, or even millions of dollars for that matter, the buyer, the investor, always wants to be protected through non-competes, but there are customary carve-outs of non-competes, and those are, even though they're customary, they're still hotly negotiated because the investor is making a commitment and wants you to make a commitment too. Hector, do you have anything else?
Yeah, I would just add that as you can probably appreciate, these are very complex deals, and they're multifaceted and multidisciplinary in nature. But the value of having really good legal advisors and financial advisors is that we do a lot of these transactions a year. I mean, we do 20, 30, sometimes 40 of them a year, and we understand what is, quote, market terms. If a private equity firm is wanting to subordinate your equity interest in a very punitive way, we can sort of be there to say, hey, that is not market, that is not a market term that we're seeing in other transactions that we're working on today. So it's really, a lot of these elements are negotiable, and that's the value of having an advisor. The other piece of advice I would say is getting your house in order. If you're even contemplating a process of this nature, or even wanting to explore the potential benefits of it, really making sure that your clinical operations, your financial controls, and all of the organizational attributes are in good working order, because that's really going to pay dividends on the back end should you elect to move forward.
Yeah, so I think we've addressed all of the questions. Thank you, and we'll be here for a few minutes afterwards if you have any specific questions you'd like to raise. But thank you very much.
Thank you.
Takes the wind out.